Welcome to Christine's Finance and Investment channel. You've worked hard and saved diligently. Now you have $100,000 to invest. But a crucial question arises. How should you invest this money? Do you take the plunge with a lump sum investment? Or do you wade in slowly with dollar cost averaging? The choice between these two strategies is not always easy. It depends on your risk tolerance, market conditions, and financial goals. This video will guide you through the complexities of lump sum investing and dollar cost averaging. Let's start by defining our terms. Lump sum investing is like diving headfirst into a pool. You invest your entire $100,000 into the S&P 500 all at once. This strategy offers immediate exposure to market movements. On the other hand, dollar cost averaging is more like dipping your toes in gradually. With DCA, you divide your $100,000 into smaller portions. You invest these portions at regular intervals. This approach aims to mitigate risk by spreading your investments over time. Both strategies have their own merits and drawbacks. By understanding both approaches, you can determine the best fit for your financial personality and investment goals. Lump sum investing is the bold approach. You invest your entire $100,000 into the S&P 500 immediately. Why would you do this? The answer lies in the potential for higher returns. Historically, the stock market tends to rise over the long term. By investing all at once, you maximize your exposure to this upward trend. Your money starts working for you right away. This strategy aligns with the principle of time in the market beats timing the market. The earlier your money is invested, the longer it has the opportunity to grow. This is where the magic of compounding comes into play. Think of it like a snowball rolling downhill. The larger the snowball, the faster it grows as it gathers more snow. Similarly, the more time your money has in the market, the more it can benefit from compounding returns. While lump sum investing offers enticing potential, it's crucial to acknowledge its drawbacks. The most significant risk is market timing. Investing a large sum just before a market downturn can lead to substantial short-term losses. This risk is especially relevant in volatile market conditions. Predicting market movements is notoriously difficult, even for seasoned investors. Another challenge with lump sum investing is the potential for psychological stress. Watching a large investment decrease in value can be emotionally draining. If the thought of potentially large short-term losses keeps you up at night, lump sum investing might not be the best fit for your personality. Now, let's shift gears and explore the more cautious approach of dollar cost averaging, or DCA. Instead of diving headfirst, imagine wading into a pool gradually. You divide your $100,000 into smaller portions and invest them at regular intervals. The primary advantage of DCA is risk mitigation. By spreading your investments over time, you reduce the risk of investing everything at a market peak. If the market dips after your initial investment, you'll be buying more shares at a lower price. This gradual approach can be particularly beneficial during periods of market volatility. DCA provides a sense of stability and can be emotionally reassuring, especially for those who are new to investing or have a lower risk tolerance. While DCA offers a smoother ride, it's essential to acknowledge its potential downsides. The most significant drawback is the possibility of lower returns, especially in a consistently rising market. When the market is trending upwards, spreading your investments over time means you might miss out on potential gains from investing everything up front. Time in the market is a powerful factor in wealth accumulation. Another potential downside of DCA is its complexity and the effort required. Lump sum investing is a one-and-done deal. DCA, on the other hand, requires ongoing management. This can be more time-consuming and might involve transaction fees, depending on your brokerage and investment choices. Now that we've explored the pros and cons of both lump sum investing and dollar cost averaging, let's turn to research to see how these strategies have performed historically. Numerous studies have analyzed the effectiveness of these approaches, and their findings provide valuable insights for investors. One such study by Vanguard compared the performance of lump sum investing versus DCA over a 10-year period. The study found that lump sum investing outperformed DCA roughly 2/3 of the time. This suggests that, historically, diving right in with a lump sum has often yielded better returns than wading in gradually with DCA. Why does lump sum investing tend to come out ahead more often? The answer lies in the long-term upward trend of the stock market. By investing a lump sum early on, your money has more time to benefit from this overall upward trajectory. DCA, while mitigating some risk, might not capture the full potential of these long-term gains. Understanding historical trends can provide valuable context when making investment decisions. The findings from the Vanguard study underscore an important concept in investing: the power of long-term trends. While the market can be volatile in the short term, it has historically trended upwards over the long run. This upward bias is driven by various factors, including economic growth, technological innovation, and population growth. When you invest for the long term, you're essentially betting on this upward trajectory. This long-term perspective is essential for both lump sum investing and dollar-cost averaging, but it's particularly relevant for lump sum investors. By investing a lump sum early on, you're maximizing your exposure to this long-term growth potential. DCA, while smoothing out the ride, might not capture the full benefit of these long-term gains. It's about aligning your strategy with your time horizon and your belief in the market's long-term growth potential. Now that we've delved into the theoretical and historical aspects of lump sum investing and dollar-cost averaging, let's shift our focus to you, the investor. The decision of which strategy to choose ultimately boils down to your individual circumstances, risk tolerance, and financial goals. If you're someone who thrives on calculated risks and is comfortable with market volatility, lump sum investing might be a good fit. On the other hand, if you're more risk-averse and prioritize a smoother investment journey, dollar-cost averaging could be more suitable. DCA allows you to dip your toes into the market gradually, mitigating the risk of investing a significant sum at an inopportune time. The key is to be honest with yourself about your risk tolerance and investment personality. Take the time to understand your comfort level with risk, your investment goals, and your time horizon. These factors will guide you towards the strategy that aligns best with your overall financial plan. Your investment time horizon plays a crucial role in determining whether lump sum investing or dollar-cost averaging is more suitable for you. Time horizon refers to the length of time you plan to keep your money invested before needing to withdraw it. If you have a long investment horizon, say 10 years or more, the advantages of lump sum investing become more pronounced. By investing a lump sum early on, you give your money ample time to ride out any short-term fluctuations and benefit from the compounding effect of long-term growth. For shorter time horizons, such as a few years or less, DCA might be a more prudent approach. With less time to recover from potential market downturns, investing gradually can help mitigate the risk of significant losses. This is particularly relevant for goals like saving for a down payment on a house or a child's education, where you need the money within a specific time frame. The longer your time horizon, the more you can afford to embrace the potential volatility of lump sum investing. While your personal circumstances and time horizon are crucial considerations, it's also essential to be mindful of the prevailing market conditions when deciding between lump sum investing and DCA. Assessing the market's overall sentiment can provide valuable insights into which strategy might be more favorable at a given time. In a bull market, characterized by optimism, economic growth, and rising stock prices, lump sum investing often shines. When the market is on an upward trajectory, investing everything up front allows you to capture the full benefit of the rising tide. DCA, while still a viable option, might result in missing out on some potential gains as you gradually deploy your capital. Conversely, in a bear market, characterized by pessimism, economic slowdown, and falling stock prices, DCA can be a more appealing strategy. By spreading your investments over time, you're essentially buying shares at lower prices as the market declines. This can potentially lower your average cost per share and position you for a stronger rebound when the market eventually recovers. Of course, predicting market cycles is notoriously difficult. Even seasoned economists and financial analysts often get it wrong. However, being aware of the market's overall mood, whether bullish or bearish, can provide some context for your investment decisions. If you're unsure about the market's direction, a balanced approach, such as a combination strategy or lump sum with a safety net, might be worth considering. As we've explored throughout this video, the choice between lump sum investing and dollar cost averaging is deeply personal. There's no universally right or wrong answer. The best approach depends on your individual circumstances, risk tolerance, time horizon, and even your psychological comfort level with market fluctuations. Investing is not a one-size-fits-all endeavor. Think of it like choosing a musical instrument. Some people are drawn to the bold and powerful sound of a trumpet, while others prefer the soothing and melodic tones of a flute. Neither instrument is inherently better than the other. The best choice depends on the individual's preferences, skills, and musical aspirations. Similarly, the right investment strategy for you is the one that aligns with your financial personality, goals, and comfort level. If you're someone who thrives on calculated risks and believes in the market's long-term growth potential, lump sum investing might resonate with you. If you prefer a more measured approach, prioritizing risk mitigation and emotional comfort, DCA could be a better fit. The key is to make an informed decision, understanding the pros and cons of each strategy and how they align with your unique circumstances. Don't be swayed by market hype or the fear of missing out. Instead, focus on what makes sense for you and your long-term financial well-being. For some investors, the best approach might not be an either-or choice between lump sum investing and dollar cost averaging. Instead, a combination strategy, blending elements of both, could offer the best of both worlds. This approach allows you to tailor your investment plan to your specific risk tolerance, time horizon, and market outlook. For example, you could choose to invest a portion of your $100,000 as a lump sum, capitalizing on the potential for higher returns from being fully invested in the market. You could then allocate the remaining portion to DCA, spreading out your investments over a predetermined period to mitigate some risk and smooth out potential volatility. This hybrid approach provides a balance between maximizing potential returns and managing risk. It allows you to participate in market upswings while also having a cushion during downturns. The specific allocation between lump sum and DCA can be adjusted based on your risk appetite and market conditions. Another variation of this balanced approach is to invest the entire $100,000 as a lump sum, but maintain a reserve of additional funds or a plan to handle potential market downturns. This strategy allows you to fully embrace the potential of lump sum investing while also having a safety net in case the market takes an unexpected dip. Regardless of whether you choose lump sum investing, dollar cost averaging, or a combination strategy, the most important factor is to make an informed decision that you're comfortable with and can stick to over the long term. Investing is not about trying to time the market perfectly or chase short-term gains. It's about developing a sound strategy aligned with your goals and having the discipline to stay the course. Remember, investing is a marathon, not a sprint. There will be market fluctuations, economic uncertainties, and unforeseen events along the way. However, by staying informed, making calculated decisions, and remaining committed to your long-term plan, you can navigate these challenges and work towards achieving your financial aspirations. The world of investing can seem complex and intimidating, but it doesn't have to be. By arming yourself with knowledge, understanding your risk tolerance, and seeking guidance from trusted financial professionals when needed, you can empower yourself to make informed investment decisions that support your financial well-being. As you embark on your investment journey, remember that the most crucial investment you can make is in yourself. Continuously educate yourself about personal finance, stay informed about market trends, and never be afraid to ask questions. The more you know, the better equipped you'll be to make sound financial decisions that lead to a brighter financial future. Thanks for watching. If you like our channel, please subscribe now, then you will not miss any videos in the future.